If you hold silver, or if you've been watching it from the sidelines, something fundamental has shifted. Not overnight, not because of a single headline, but beneath the surface in the structures that govern how money flows, how debt is managed, and how value is measured. A change is underway that most people won't recognize until it's already reshaped the landscape. This isn't about predicting the future. It's about understanding what's already happening and what it means for you. Whether you're someone who's held physical silver for years, someone who's considered it but never pulled the trigger, or someone who's simply trying to make sense of a financial system that feels increasingly unstable, what you're about to hear matters. Let me be clear from the start. This isn't hype, it's not fear, it's not a call to panic or a promise that you'll get rich quickly. What this is a conversation about cycles, about history, about how markets behave when certain conditions align, and about how thoughtful people navigate uncertainty without losing their discipline or their perspective. Over the last several months, something has changed in the way professional analysts are looking at silver. Not just the price, but the structure, the momentum, the underlying forces that have kept silver compressed for years. And one of the most respected technical analysts in the field, someone who's built a career on recognizing structural shifts before they become obvious, has issued a warning that deserves your attention. But before we talk about what that warning is, we need to talk about why it matters. Because if you don't understand the context, the warning is just noise. And there's already enough noise in the financial world. Silver is not a normal asset. It never has been. It sits in a strange place between industrial commodity and monetary metal, between speculation and utility, between forgotten relic and strategic resource. And that's exactly why most people misunderstand it. When gold moves, people pay attention. Gold is simple. It's the ultimate store of value. It's what central banks hold. It's what investors turn to when they lose faith in paper. But silver? Silver is messy. It's volatile. It's used in electronics, solar panels, medical equipment, and batteries. It's hoarded by some and ignored by most. And because of that dual nature, it behaves differently than almost anything else. Right now, we're living through a moment where both sides of silver's identity are under pressure. On the monetary side, we have inflation that won't go away, debt that keeps expanding, and currencies that are being debased at a pace that would have been unthinkable 20 years ago. On the industrial side, we have a green energy transition that requires silver in quantities we simply don't have the supply to meet sustainably. And yet, the price has been relatively quiet. Until recently. What's changed isn't just the price. It's the structure of the move. It's the way silver is breaking out of patterns it's been trapped in for years. It's the way momentum is building not from speculation, but from something deeper, something more fundamental. Technical analysis gets a bad reputation sometimes, and often for good reason. Too many people use it to make wild predictions. Too many turn it into astrology for traders. But when done properly, technical analysis is simply the study of behavior, market behavior, investor psychology, the footprints of money moving through the system. And what certain analysts are seeing right now in silver is a structural shift, a change in momentum that historically has preceded major moves, not because the charts create the move, but because the charts reflect what's already happening beneath the surface. Michael Oliver, for those unfamiliar, has spent decades developing a methodology that focuses on momentum rather than price. He doesn't care if silver is at $20 or $30. He cares about whether the underlying momentum is building or fading, whether the structure is breaking down or breaking out. And his work has called major turning points in commodities, currencies, and metals over the years, often well before the mainstream caught on. His latest work on silver is unambiguous. The momentum structure has shifted. The conditions that kept silver range-bound for years are breaking down. And if history is any guide, what comes next is not a slow grind higher. It's a repricing. A recognition of value that's been suppressed, ignored, or misunderstood. But let's be careful here. This doesn't mean silver is going to double next week. It doesn't mean you should liquidate everything and go all in. What it means is that the probabilities have shifted. The risk-reward equation has changed. And if you're someone who holds silver or someone who understands why it matters, you need to understand what's happening and what it could mean for the months and years ahead. Let's talk about what's driving this shift, because it's not just one thing. It's a convergence of forces that are rarely aligned all at once. First, there's the monetary side. Central banks around the world have printed more money in the last 4 years than in the previous 40. Debt levels, both public and private, are at levels that cannot be sustained without either default or debasement. And inflation, real inflation, the kind that eats away at purchasing power, is not going away just because headline numbers moderate. When people lose faith in currency, they don't rush into stocks, they don't pile into bonds, they look for something real, something that can't be printed, something that holds value across time and across borders. Historically, that's been gold. But silver, because of its smaller market and dual use case, tends to move faster and further when that shift occurs. Second, there's the supply side. Silver production has been flat or declining for years. Most silver comes as a byproduct of copper, lead, and zinc mining, which means it's not responsive to price in the way a primary metal would be. You can't just turn on more silver production because the price goes up. It doesn't work that way. At the same time, industrial demand is accelerating. Solar panel production alone is consuming silver at a pace that was unimaginable a decade ago. Electric vehicles, 5G infrastructure, medical devices, all of these require silver. And all of these sectors are growing, not shrinking. So you have a situation where demand is rising, supply is constrained, and the price has been held down for years by paper markets that trade far more silver than actually exists. That's not sustainable. Something has to give. Third, there's sentiment. For years, silver has been the asset that disappointed. The asset that skeptics pointed to as proof that precious metals don't work. The asset that inspired more frustration than confidence. And that's exactly the kind of environment that sets up for a major move. Because when everyone has given up, when the weak hands have been shaken out, when the narrative is that it's dead money, that's when structural shifts happen. Now, let's talk about what this means if you already hold silver, because that's a different conversation than what it means if you don't. If you're someone who's held physical silver for years, you've likely been frustrated. You've watched gold make new highs. You've watched Bitcoin grab headlines. You've watched equities grind higher, and silver just sat there, grinding your patience down month after month. What's happening now is the beginning of the move you've been waiting for. But here's the critical part. You still need to be patient, because structural shifts don't happen in a straight line. There will be pullbacks. There will be moments where it feels like nothing has changed. There will be days or weeks where the price drops and the doubts creep back in. Your job is not to react to every move. Your job is to understand the bigger picture and hold your position with conviction. If the momentum structure has truly shifted, and all signs suggest it has, then what you're looking at is a multi-year repricing, not a quick trade. That requires discipline. It requires tuning out the noise. It requires remembering why you bought it in the first place. And if you're someone who doesn't hold silver yet, or someone who holds very little, this is the moment to educate yourself and consider whether it fits into your broader strategy. Not to chase it, not to go all in because someone on the internet told you to, but to thoughtfully assess whether this is an asset that makes sense for you, given the risks you see in the system and the way you think about preserving wealth. The mistake most people make is waiting until the move is obvious, waiting until silver is up 50 or 70%, and every headline is screaming about it. By then, the easy part is over. The risk-reward has shifted, the momentum chasers have arrived, and the volatility becomes extreme. If you believe that the financial system is built on unstable foundations, if you believe that inflation is not transitory, if you believe that currency debasement is the path of least resistance for governments drowning in debt, then silver is one of the few assets that makes sense, not as a speculation, not as a trade, but as insurance, as a hedge, as a way to preserve purchasing power in a world where paper promises are becoming less reliable. But you have to approach it correctly. You can't leverage it. You can't treat it like a lottery ticket. You can't expect it to perform on your timeline. You have to buy it, hold it, and let the cycle play out. Let's talk about cycles for a moment, because this is where most people get lost. Markets don't move randomly. They move in cycles driven by human psychology, by capital flows, by policy decisions, and by structural imbalances that build up over time and then correct violently. Silver has a history of long, quiet periods followed by explosive moves. In the late 70s, it went from $5 to $50 in a matter of months. In 2011, it went from under $20 to nearly $50 in less than a year. Both times, the setup was similar. A long period of accumulation, a shift in momentum, and then a recognition of value that had been suppressed. We may be at the beginning of another one of those cycles. The difference this time is the scale of the monetary imbalance. The difference this time is the structural demand from industries that didn't exist in previous cycles. The difference this time is that more people are aware of the fragility of the system, even if they don't know what to do about it. But cycles are not guarantees. History rhymes, but it doesn't repeat exactly. There are always risks. There are always uncertainties. And that's why you have to approach this with humility, with discipline, and with a plan. Now let's talk about what not to do. Because in moments like this, when something starts to move, when the narrative shifts, people make predictable mistakes that cost them dearly. Don't chase the price. If silver runs up 20% in a week, that's not your signal to buy. That's your signal to stay calm and stick to your plan. If you don't already own it, wait for a pullback. If you do own it, don't sell into strength just because it feels good to see a profit. Remember why you're holding it. Don't overleverage. The temptation to use margin, to buy options, to amplify your exposure because you're convinced the move is coming. That's how people blow up. Silver is volatile. It can drop in 10% in a day for no reason. If you're leveraged, that volatility will destroy you even if you're ultimately right about the direction. Don't follow the hype blindly. There are people online right now telling you silver is going to $100, $200, $500. Maybe they're right. Maybe they're not. But if you buy because someone made a bold prediction, you'll sell the moment things get uncomfortable. You have to own your conviction. You have to understand why you're in the position. Don't ignore risk management. Even if everything we've discussed plays out, there will be moments of doubt. There will be drawdowns. There will be news that shakes your confidence. If you don't have a plan for how much you're willing to allocate, how much volatility you can stomach, and what would make you reassess, you'll make emotional decisions at exactly the wrong time. And finally, don't forget that this is just one piece of a broader strategy. Silver is not your entire portfolio. It's not the only answer. It's a tool, a hedge, a way to protect against specific risks. But you still need cash, you still need income, you still need diversification, you still need to think long term. What's happening with silver right now is significant. The momentum shift is real. The structural forces are aligned in a way they haven't been in years. And if you're paying attention, if you're thinking clearly, this is a moment to act thoughtfully, not impulsively. For those who hold it, this is validation. Stay patient, stay disciplined. Don't let short-term volatility shake you out of a long-term position. For those who don't, this is a moment to educate yourself and decide whether it fits into your plan. Not to chase, not to gamble, but to make a reasoned decision based on the risks you see and the way you want to protect what you've built. The financial landscape is changing. The old rules are breaking down. The systems we've relied on for decades are showing cracks. And in that environment, real assets matter. Tangible value matters. Things that can't be printed or manipulated matter. Silver is one of those things. And right now, after years of being overlooked, ignored, and dismissed, it's beginning to wake up. Stay informed, stay disciplined. And remember that the best investors aren't the ones who react to every headline. They're the ones who understand cycles, manage risk, and have the patience to let their thesis play out.